Traders at UBA say they expect tight liquidity to drive minimal demand in the bond market after Monday's bond auction, where 656 billion naira was sold. Chuka Nwachukwu, the head of ALM and balance sheet management at UBA, joins me now for a market update. Chuka, it's a pleasure to have you join us today. Obviously, we are seeing the impact of that bond auction on liquidity in the market. Can you just bring us up to speed in terms of how tight things are right now and how you see things evolving in terms of liquidity?
Okay, thank you. Like you rightly mentioned, there was a bond auction on Monday. 360 billion was on offer, well over 655 billion was sold. Subscription was around over 900 billion. And so that has actually affected market in terms of liquidity. We've seen a tight liquidity from last week to this week. Market is a negative of well over 400 billion. And today is the bond auction settlement. And obviously, over 650 billion will be settling today. And that has actually put pressure, in terms of liquidity in the market.
All right. So let's talk a bit about that yield curve, because I think it's useful for our audience to understand why it is so steep. Clearly, we're seeing 1 to 3 month paper closer to 3%. But by the time you're hitting 3 years, we're now in strong double digits. It seems pretty steep in terms of the climb, and I believe that will be really related to the participants, or if you like, in both segments of the market. Can you explain that for us?
Okay. Barely 2 months ago, we've seen a yield on the T-bills market, for example, close at 14.75. And 2 months later, we've seen this yield trading around 5%. This is because of the liquidity in the system. Liquidity actually has been driving the pace, have been dictating the pace in terms of trading. And so we've seen yield nosedived, from 2 digits to to a single digit. Again, another factor is the fact that there are just few investment opportunities in the system, mostly the T-bills and the bond. And so we've seen that many of the investors are likely to play on the longer end of the curve for the T-bills. However, if you have a T-bills, a 1-year T-bill that is trading around sub 5%, most investors prefer to buy the shorter end of the curve on the bond side, which is the 2025 and 2026, and that obviously is trading around 12%, 11.5%. So the liquidity has driven down the trading, and has actually caused a lot of nosedive in the yield curve.
And take us into the I&E window right now in terms of how the closing exchange rate may not necessarily reflect the dynamics during the day, because what I'm hearing is that in terms of the actual prices at which deals are done, it is a relatively wide range.
Yeah. So on the exchange rates, the convergence after the recession was lifted, the essence was to just have a single exchange rate between the I&E, the official market, and then the parallel market. But of late, we've seen a huge, difference in terms of, the I&E window. For example, the I&E is trading around 742 levels. The other end of the market, which is the parallel market, is trading around 8, sub 9, and upper 8 levels. So as long as there's this huge demand, that's what I actually wanted to explain as well. The demand in the market is quite huge, and so part of the problem we see is that a lot of customers really don't understand the pronouncement by CBN. Some just assume that as long as CBN has said, look, the cap is lifted, it means that there will be inflow of dollars. And so not knowing that the demand that is still in the system is quite huge, and that's why we continue to see the rate go up.
And fixing that demand issue, many are suggesting that the central bank has to find a huge supply of dollars to address it. And if we look at the trends in the past, this goes back to maybe even 3 or 4 years or 5 years ago, where we would see the central bank try to tackle built-up demand with maybe special sales and so on and so forth. Now, the big challenge now is that the resources are not as they used to be in terms of the buffer that the central bank has in terms of reserves. So how do you see that dynamic working, as we all hope to see a situation where that market becomes a lot more liquid and a more stable exchange rate?
I think that to address this issue, you have to address it both from the monetary perspective as well as the physical side. Let me talk about the physical side. The government needs to come up with some of the challenges that is affecting our crude oil. I mean, our major export is the crude, and so when you have issues of oil theft, bunkering and here and there, government need to address those issues so that we can, meet up to our own quota and then be able to export more and earn more exchange rates. Now, on the monetary aspect, I believe that CBN is doing what they can. They are trying to see how best to, to cushion the effect by by intervening in the market. And we've seen that a couple of times this week and last week when the rates were going up and then CBN came in and intervened. However, there's little CBN can do in terms of the demand. The demands keep coming. And so I believe that we must tackle this issue both from the fiscal policy and then the monetary policy.
All right, let's leave it there. Thank you so much for your perspective today. I will speak with Chuka Nwachukwu, Head of ALM and Balance Sheet Management at UBA.